Good morning, everyone. Greetings to you from Eagles Nest Lodge, way up in way northern Minnesota. I'm here this weekend walleye fishing with my son, and I wanted to send you this short video because I've gotten a number of emails saying that Tuesday is problematic as far as going through that review sheet. So rather than tying you down to a specific date and time, I thought I'd put together this review sheet for you, or this video for you to go through this review sheet, and then we've got that covered. So if you could pull out your review sheet with me, and then what I'm going to do here is also have this on the screen, and I'll go through this with you. So the first one is chapter 22, and it's been a while since we've looked at chapter 22, but it's a good chapter. It's one that we talked about on budgeting. So, point number one, reread chapter 22. Absolutely make sure you've read it. Number two there, it says look at all of those practice multiple choice questions and exercises and problems, and make sure you've done that. It's all located at the end of the chapter. And those discussion questions, there's solutions also on the LMS. Number four is an important one. We assign these exercises and problems for a reason, so make sure you review those. Number five, the chapter discusses responsibility centers. Having read that, you would see it discuss responsibility center. You can find that on page 1100. On number six, know the differences in was a static budget, page 1103, a continuous budget, page 1102, a zero-based budget, 1103, and a flexible budget, 1104. So pages 1102 through 1104 will make sure you understand what those are, and as well as make a note that ties to exercise number 2. Number 7, know how to set up a production budget. And if you look in your book, Exhibit 10 on page 1108. Exhibit 10, page 1108. What are the principal components of a master budget? That's in Exhibit 7 on page 1108 again. So Exhibit 7. And number 9, generally, which budget do we start with? And we've talked about that many times, and you'll see that on page 1108, but the sales budget. The sales budget leads everything. And the number 10, know how to set up a sales budget, a direct materials purchases budget, and a cash collections budget. Well, the sales budget, look at Exhibit 9 on page 1108. The direct materials purchases budget, look at Exhibit 11 on page 1110. And then the cash collections budget, make sure you look at Exhibit 17 on page 1117. 1117. On that cash collections budget, I would also review exercises 17 and 19. 19 is cash payments, but they run the same way. So look at 17 and 19. With all of these budgets for number 10, I would make note that you especially look at exercises 5, 6, 8, and 9. 5, 6, 8, 9. So that's basically steps 5 through 10. And number 4, review all your exercises and problems that we assigned. That's very important. And I identified those exercises that tie to some of these key points. But a really good problem to review that kind of captures everything in this chapter is problem 2A. We put together a bunch of budgets in that one: the sales budget, the production budget, the direct materials purchases budget, and then the direct labor budget. So it does not have the cash collections budget, so that has another exercise to look at. But this is a very good problem that kind of does a nice review of the chapter. Okay, moving on to chapter 25. When we get to 25, we start talking about differential analysis and product pricing. And I told you this at the beginning of this chapter. I'm not too concerned how you set up your problem. You can set it up many different ways. What's important is that we know what's important, the differences in this. So again, number one, make sure you've read chapter 25. Number two, at the end of the chapter, look at those practice multiple choice questions, exercises, and problems, and those solutions are included. That's a very good thing to look at. Look at all those discussion questions. Again, those solutions are provided to you. And then review all your exercises and problems, and we'll look at some of those that I feel are very important that tie to some of these points. So number 5, make sure you know the meaning, definition, or how to calculate these various items. So I'm going to tell you where you can find a lot of them. Well, contribution margin, that comes from a previous chapter anyway, but sales minus variable costs is your contribution margin. Okay, so let me scroll this down here a little bit. So we know what that is already, sales minus variable costs. B, C, and D, this differential revenue, differential cost, differential profit is sometimes what it's called instead of income. Look at page 1258. It's a nice definition for all of those. The period and the product costs. Again, this is from previous chapters. We don't really need to talk about it, but if you need to look at the definitions and what's included, page 761 from chapter 15. Okay, discretionary cost. There's probably not going to be a definition in your text, but let me just tell you this. A discretionary cost is something that you can eliminate right now, and it has no impact on this immediate short-term profit. So we can get rid of this cost right now, and it's not going to make a big difference to our profits in the very near future. So it's a cost that you can eliminate with very little short-term effect. Opportunity cost, look at page 1265. Sunk cost on page 1260. Replacement cost, page 1264. And then the relevant costs and revenues. And what do we mean there? Well, what we mean is what's important, what's relevant, what do we need to factor, and what do we not need to factor. And an example would be fixed costs. Well, as long as you have fixed costs in both alternatives or neither alternative, you're fine, right? Because the moment you put it in one column and not the other is when you're going to make a mistake. Fixed costs are going to be there whether you do the alternative or not. So as long as those amounts are included in each alternative or they're eliminated from both, so it keeps it the same, you're fine. You just need to know what is relevant. Know how to calculate differential revenues and differential costs. Let me tell you, your exercises, that's all we did. Differential revenue, differential costs. Okay, what pages are there, or what exercises? So there's quite a few of them, quite frankly. It would be exercises 1, 3, 6, 7, 9, and problem 2A. It really hits the differential revenues. And differential costs, many of those same exercises I just listed before already, exercises 11 and 13. I mean, differential revenue and differential cost, that is what we did. That is chapter 25. Sunk cost and opportunity cost, you can look again at exercises 14 and problem 1A. Sunk cost is a cost that is nothing we can do about anymore. It's done. It's a purchase that we made and we can't undo it. We need to keep those costs out of the scenario. It's a sunk cost. We cannot undo that. An opportunity cost, again, I would look at page 1265. And then number 7 there, know how to calculate contribution margin or a contribution margin per hour or machine hour or whatever. And those we did in those exercises. But contribution margin, sales minus variable costs is contribution margin. Okay, moving to chapter 26, which we just finished. Again, make sure you've read it. If you need to, look at those practice questions and exercises and problems at the end of the chapter. Look at some of those discussion questions. What's the best way to know chapter 26? You've got to understand those exercises, right? You've got to have reviewed those. And there they are, listed in number 5, cash payback, cash payback. Letter B, average rate of return. Those are the two that do not factor in the time value of money. A and B. Cash payback, we're looking at cash flows. Letter B, average rate of return, we're looking at income. Okay. Letter C, net present value method. Letter C and letter E. Letter C and letter E are the two methods that factor in the time value of money. Okay, so in letter C, net present value, like I've said to you many, many times before, make sure you set it up the same way every time. That's how we did it in the problems. Okay, I'm going to jump to letter E, internal rate of return. Remember, the one thing that we do first is calculate the present value factor. Present value factor. And what is the present value factor? That formula essentially is cash payback. So there's nothing new. Cash payback. So make sure you remember that. Now, I will tell you there will be a question on the exam that asks you to calculate the present value index. We did it one time, and it is in problem. Bear with me here. It is in problem 4A. It'll be just that straightforward and that simple. Problem 4A. Make sure you know how to do the present value index. Okay. One thing I should tell you, all annuity tables, all of them, whether it's the present value of $1, the lump sum, or the present value of an annuity, will be provided to you in the exam. Okay, so you don't need to have another sheet, or you don't have to bring your tables, you don't have to bring your book. All of that will be provided to you in the exam. Okay. Now, letter S says the two tables we use, the present value of a lump sum or a buck or the present value of annuity. We need to know how to use them, like whether it tied you to the exhibit or whether it tied you to back in the appendix. Those will be provided to you, but you need to know how to use them or what's the difference. So when there is a different cash flows for every year, we're doing the present value method now, you got to use the present value of the lump sum. You got to calculate it each year. If it happens to be that that cash flows is going to be the same for all 15 years, you can use the present value of an annuity. Okay, the present value of an annuity. So the best way to, I believe, to get a good understanding of chapter 26 is, once again, know your exercises and your problems, and number 2, make sure you've read the chapter, so when there's something discussed, a multiple choice question, that you know what are some of the other issues or concerns that we've talked about from chapter 26. I tell you, that takes us to the end. That is the review for 22, 25, and 26. And I'm certain you would agree with me, this is not how we would have liked to have ended our second semester. I much prefer having you in class, and where we can banter back and forth and have a good time, and we can laugh together. Unfortunately, with this whole outbreak, it was not possible. But I will tell you this, you guys have done well. You're finishing strong. We'll be back again in the fall, and I hope that you take the time to stop by. I know many of you will be done with accounting. You'll take one more cost management class with Professor Whitley. For those of you that are minoring in accounting or certainly majoring in accounting, I will see you again. But for many of you, this will be my last time having you in class, and I wish you the best of everything. I pray for you, and I hope to see you again soon. You guys have a great summer, and I wish you well during finals week. Take care, everyone.